Well, hello everyone. As you know, in the past, I've done these videos just to give you a quick update on the markets and what's going on. This time, I'm going to try something a little different. I have Dominic with me, who chairs our investment committee. We're going to talk about the markets a little bit and some of the things we're doing for our clients within their accounts. This is also going to probably be a format we're going to move to for a new podcast we're looking to roll out, which will focus on not only the markets and investments, but financial planning, business management, things like that. So we're gonna give it a try and see how it goes. Good morning, Dominic. How are you doing?
Good morning. I'm doing well. Recovering from a wedding over the weekend. So,
Oh yeah, how was it?
yeah, it was great. Best food I ever had. So
Really?
congrats to Rich and Molly.
It's good to know. Usually weddings, they're we the food is usually not up to quite par, but that's good to hear.
Oh, yeah, great. So,
All right, so markets are down. We're getting some a few client calls, but really every client I'm talking to during review meetings clearly and obviously are concerned about the markets and what's going on. And probably more important, what they're really asking is what's next. So want to take this opportunity to talk a little bit about it, and then we'll send it out to everyone, give a little update on what we're doing. Since you kind of run our investment committee, want to give us an update on the committee. But before you do that, actually, let me take a quick step in. Before you do that, let me just give a quick review of what the investment committee does. We have an investment committee. I believe right now it's the five partners and Dominic, who are the voting members, and then we have a couple of the other advisors who are allowed to sit in on any of the meetings, give their feedback and give the advice, but I don't think technically they're voting members of the committee. We meet once a quarter. So typical meeting, the first one third of the meeting is talking about just the markets and the economy, where we view things, where we think they're going to go. And we try to get a consensus among the committee to be the FPA position. The second
yep.
third of the meeting is based on our views of the markets. How should we shift the portfolios from a tactical asset allocation perspective? Again, we don't make wholesale changes. We're not market timers, but based on what's going on in the market, we will tweak things, go plus or minus 1 or 2% here or there. And then the third part of the meeting, we go through and review all the funds in all of our client accounts against 11 different criteria uh, to see if they are passing the muster. And if they're not doing what we expect them to do, we will put them on the watch list. Or if they're continually not doing what we expect them to do, they will be terminated and replaced. So that's where it stands. So Dom, give us a little quick update on our last investment committee meeting, which actually, again, I'll chime in. Normally meet on the quarters, usually 2 weeks after the quarter closes. But given on what's happening in the markets right now, we just had a third meeting so far this year, just last week. So go ahead, Dom, give us an update.
Yeah, let's start with what we did in January. So we met, beginning of the year, and we were coming into the year favoring stocks over bonds,
Mhm.
particularly within stocks. We favored U.S. over international or developed markets. So that's emerging markets and large foreign markets. We favored U.S. Over those markets. On the fixed income side, we favored credit exposure over core bonds or high quality.
Mhm.
The reason for that is we knew interest rates were going to begin to rise. That's the way we started that year in January. A lot has happened since then. So
Yeah.
when we met in the beginning of the second quarter in that mid-April range, we reviewed and kind of said that at that point we were going to continue to stay the course. We still favored U.S. over international, especially with what's going on in Russia, Ukraine. We still favored at that point credit over core bonds.
Mhm.
Just recently, though, we had that ad hoc meeting, and that's really where we just started to say that valuations have come in for core bonds, really attractive. So what we've decided more recently is to make it a shift here and go from a little bit less exposure into that credit and a little bit more exposure back into core bonds there. And then on the equity side, we're really looking at, we still favor US over international there as well. So really not much of a change on the equity side, but we're seeing that shift in the core fixed income space.
Yeah, if you think about coming into the year, we say we're favoring stocks over bonds. With the stock market being down 19%, that would on the surface sound like it was a terrible decision. But truth be
Right.
told, for as bad as it's been for the stock market, relatively to what historically we could expect from bonds, this has been a historically bad market for the bond market. So even though we made that decision to overweight the stocks, it actually wasn't a bad decision. We actually benefit somewhat from that perspective, and we definitely will benefit once the market does bottom out and start coming back up. Dominic, talk about what are some of the things we're looking at right now moving forward as we look through the second half of, well, not even second half, as we sit here in late May, June, July, August. What are some of the key things we're watching?
So we got three things really. The first is the Fed. Are we going to have with their projected interest rate hikes, what they call a soft landing or a hard landing, right? We're going to be able to smooth out this ride, or is it going to be a little bit bumpy?
Yeah.
The second thing we're looking at is a recession. Is it anywhere? Are we near a recession? Are we in a recession? Is it coming soon? And lastly, it's what's going on in Russia, Ukraine, right? Is there going to be some type of escalation, or is there going to be some type of solution?
Yes. Yeah. I mean, if you think about that, from those three things, the Fed, what was it? Fed, the Putin and
Recession.
Ukraine. Um, those are probably the two things we obviously look at very closely. Coupled to are those two things going to push us into recession? Uh, right now, we don't see a recession on the horizon. It may be just over the horizon, but as of right now, we don't see it on the horizon. So maybe second half of 2023 into 2024, but not for 2022. That's important because if you look at historically, the historic bear, so we're definitely going to pay attention to Russia because if that spills over to other countries, that's going to change things. And
Yep.
obviously, we're going to pay attention to the Fed. The Fed, I think we all agreed in the committee that we see them raising, they already raised 50 basis points
Yep.
last month. They're going to do probably 50 basis points again in a couple of weeks. And wouldn't be surprised to see 50 again in July. They'll probably keep raising rates until they get closer to the fall and then pause. Fed doesn't like to be very active around elections. They don't want to be perceived as putting their foot on the scale. So we think they're going to pause come fall, take a look, see where inflation is coming out at. And if it's still rising, they'll start raising rates again. But if it's what we think it would be, which is inflation starting to pare down over the summer, they probably will tamper their interest rate increases.
Yeah, I think there's to put one thing in perspective, that 1987 crash, I wasn't born yet, so that's about 35 years ago. So
Yes.
just to tell you about how rare that is.
Yeah, true. Let's talk about the planning side. Obviously, clients are calling and asking, what should we do? Well, the obvious answer is nothing. And there's a reason for that. It's not that we like sitting on our hands. The reason is the time to make changes or to be properly allocated is before the market drop, not after. Once the market drop happens, it's typically too late. Once in a while, we'll have clients say, well, can I move the cash until this all settles down, until I feel comfortable again, and then jump back in? And the problem is, you got to get that right twice. You got to know when to jump out, and you already messed up that one because we already dropped, and then you know when to get back in. Research has shown if you miss just the 5 best days of a market recovery, you're going to lose 38% of that recovery. So if the goal is to get back to where we started in January, sit tight, trust the plan.
Yeah, and like you said, Shane, staying invested doesn't necessarily mean you can't make some changes.
Right.
Making a small allocation change to take advantage of good valuations or take advantage of a potential rebound.
It's a great point.
For long-term investors, that makes absolute sense.
Mhm.
Going to cash, though, is nearly the wrong decision in almost every single circumstance.
Yeah.
And then, but it was a very good point taken.
If you look at where we are with the economy, I mean, earnings season seems to be relatively strong. So what we see is earnings are strong, prices have come down. That takes our price to earnings, or what we basically call a valuation of stocks, to be relatively attractive. So we see both on the bond side, which we already talked about, moving back into core bonds, but we're also seeing on the stock side where valuations have become very attractive. So for our longest term investors, investors where you're not touching the money for 10 years or longer, it might be a good time to buy stocks and what we call buy the dip, and maybe take your portfolio a little bit more aggressive for a short period of time. Or if you have money on the sidelines, now's a great time to get it invested. For money that you need in the short term being 2 to 3 years or less, that money should always be safe and stable. We should have that in what we call a short-term reserves portfolio. So where a really bad market like this, that account's going to be down maybe 2 to 4%, not the 19% we see in the stock market right now. Midterm money, somewhere in between, depending on your personal situation. So planning should always be done on the front end of a pullback, not on the back end or not during it.
One thing I like to chime in there is when we think about the short-term versus long-term argument. If you think about
Mhm.
bear market recessions, the average recovery is about 19 months.
Yeah,
Bear market recessions, bear markets without a recession, excuse
correct.
me,
Yes.
that recovery is about 7 to 8 months.
Yeah,
I mean,
much
right
quicker.
there alone, you're along the shorter term. So for again, short-term investors, we want to make sure we are a little bit more conservative because that 7 to 8 to 19 months could happen really whenever. But most of us are long-term investors, right?
Mhm.
Looking for 10 plus years out, plenty of time to kind of weather the short-term volatility.
Yeah, and that goes back to play to our argument that if we're correct and a recession really is not on the horizon, we have some time till we really are worried about a recession. That what was a 7 to 9 month average bear or near bear market. We're already seven, or no, excuse me, not seven. We're already 5 to 6 months into it. So
Right,
again, it builds on our argument of that we're closer to the bottom than we are to the top.
right.
Okay, this is good. I like this. We should probably do this more often. You enjoy it?
Uh, I agree. Yes, takes me away from answering some emails too. No, I'm just
Yeah.
kidding. Just kidding.
Nah, this is a great way to get in touch with a lot of people. Uh, if you have any questions about some of the things we spoke about, or more importantly, if how those things affect your portfolio, please give us a call. You can schedule time with Dominic or I. We can talk about your portfolio, your plan, and talk about how these things specifically affect you. Other than that, I hope everyone has a good day, and we'll get some more videos like this out to you. Take care.
Take care.
Opinions voiced in this video are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance reference is historical and is not a guarantee of future results. All indices are unmanaged and may not be invested into directly. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and FPA Wealth Management are separate entities from LPL Financial. Any outside guests in this video and their company are not affiliated or endorsed by LPL Financial, Private Advisor Group, or FPA Wealth Management.